Fiverr stock is down 35% year to date in 2025. And of course, I'm disappointed in that because I've had Fiverr stock rated as a buy all year long. But unlike other YouTubers who neglect the stocks they recommend that underperform, I continue covering the companies that even underperform given my recommendations. I keep track of all of these figures and I update you regularly on their performance. So in this video, I'm going to highlight what's been going on with Fiverr, why the stock price is falling, and whether or not I still think this stock is a buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the biggest reason why Fiverr stock is down in the recent month and a half or so is because when the company reported quarterly financial results, they reported a huge decrease in annual buyers down to 3.3 million. This is something that's been fluctuating for Fiverr in recent years following the economic reopening, but there's a good reason for that. Fiverr has been increasing the fee that they charge. So let me zoom out a little bit. Fiverr is a gig economy platform that brings together people that want to sell their services and people that want to buy their services. And so Fiverr takes a fee for every transaction that happens on the platform. And Fiverr's been increasing that fee for several quarters now, several years now, and that fee has increased to roughly 30%. Among the highest take rates of any of the companies that I follow that operate on this kind of business model, which is the platform business model, a business model that I find to be very attractive. So other examples include Uber, which is actually rated as my best stock to buy right now. They bring together two sides of a transaction also, purchases of rideshare and those that offer rideshare. And so that's another platform business model. Airbnb is another one. eBay is another one. Etsy is another one. And I can go on and on. These are attractive business models that operate on excellent profit margins because of the asset light business model, right? They don't need to invest in these things that are being sold and purchased on the platform. They just create the platform, the maintenance, the support to bring together buyers and sellers of services. So that's one of the reasons why I've been attracted to Fiverr is because of that business model. And the 30% or roughly 30% fee is the highest among any. But all of those companies I mentioned earlier, they've also all been increasing that fee in the take rate on the platform, which demonstrates the pricing power that these platforms boast. Once people join the platform, an incremental increase in the fee allows the company to generate higher profits from those that are engaging, and they might lose some customers that were not strongly attached to the platform. And the management team has talked about how they want to go after more profitable customers. They don't just want to increase their monthly active user numbers. They want to increase the revenue and profitability of the company overall. So the company reported revenue growth of 8.3% in the most recently completed quarter. And that was very attractive, as well as the average revenue per buyer increasing by roughly 24%. So you can see existing buyers on the platform are engaging more frequently, and those are the kinds of users that Fiverr wants to keep. If Fiverr is going to lose a customer because of an incremental increase in fee, they're okay with losing that customer. But it is still concerning when they are losing that many buyers, which was down approximately 11.7% year over year. So they shed roughly 300,000 buyers during the most recently completed quarter compared to the same quarter the prior year. So that is a risk. However, they did outperform in terms of revenue and profitability in the most recently completed quarter at revenue of 8 million, 107.9 million to be precise, and 77 cents in earnings per share. Both exceeded expectations, and management forecasting against the next quarter of similar revenue of around 108 million at the midpoint. This management team, by the way, is one that has consistently outperformed expectations. They consistently provide a lower bar and then jump over that bar. So the analysts on Wall Street have grown accustomed to that. And you might be wondering, is that a good thing when a company always beats their expectations? And I say no. The reason for that is if they're always beating their expectations, that means they're setting the bar too low. They're giving a forecast that's too low. And so, as an analyst, I need to adjust their forecast based on their consistent under forecasting and over delivering, right? It's the opposite of Tesla, which always over promises and under delivers. And so, I need to adjust whatever they say downward. And with Fiverr, it's the opposite. They over deliver and they underpromise. And so when they give you 108 million forecast for the upcoming quarter, I need to update that higher. Maybe 110, maybe 112 million is the more appropriate figure to forecast forward. And either way, either too high or too low, I don't like when management teams do that. It makes it more uncertain to evaluate the company. I need to make an adjustment higher and I need to question how much to adjust higher, and with Tesla, how much to adjust lower. It makes it more difficult to conduct financial analysis. I'd prefer management teams provide accurate information to investors. Accuracy is what I prefer, not under promising and over delivering or over promising and under delivering. Because if you're in the habit of doing that, then I need to adjust my figures based on your habits. I don't like to do that because it creates more uncertainty. It creates more room for error compared to a management team that just provides me with accurate forecasts. So that's the biggest reason why Fiverr stock is underperforming in the most recent quarter. Zooming out from that, you can understand investors are concerned that artificial intelligence is hurting this company's prospects, as they believe that entrepreneurs will use AI to complete tasks instead of hiring somebody on the Fiverr platform to complete those tasks. I think those risks are overblown because I think entrepreneurs would prefer to hire somebody who is using artificial intelligence to complete those tasks rather than use artificial intelligence themselves to complete those tasks. So it's going to create, in my opinion, a bifurcation in the Fiverr platform. Those that are offering services that incorporate AI are likely to gain increasing customer adoption, and those that aren't using AI to offer services are going to be left behind as entrepreneurs look to those that offer more efficient services, more value for the dollars being spent. So, all that being said, what do I think about the valuation? I calculated a fair value for Fiverr stock at $65. That's significantly above the current market price of $21 per share. So, I see this stock as being significantly undervalued based on my proprietary DCF calculation. And then when I go to fiscal.ai, which is my preferred data provider, and retrieve the forward PE and forward price to OCF ratios, it also looks ridiculously cheap, trading at a forward PE of 7 and a forward price to OCF of 7. This is ridiculously cheap for a company that's growing revenue near double digits, operating on an asset-like business model with a total addressable market in the hundreds of billions, if not trillions of dollars. So a long runway for growth if they can continue expanding their customer base and increasing engagement from existing customers. The risks are, of course, artificial intelligence and how that will impact the business. In my opinion, I've stated that it's going to be a net neutral impact on Fiverr's business. There's going to be some categories where it will lose some business, and there's going to be categories where it will win some business. And in net, I forecast that artificial intelligence will be neutral for the company, while Wall Street and investors overall are estimating that artificial intelligence will be a significant negative for the business. That's my biggest difference between the average analyst on Wall Street and how they feel about Fiverr stock. So I've had this stock rated as a buy, as I mentioned all year long, and I will reiterate that rating today. I like this business, especially at this new lower valuation. I think it's attractive for long-term investors. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.